A very good morning to all the students and wishing all of you a very happy new year. So today we will start our discussion with the topic of interest rate risk management. So first of all, let us try to understand what is interest and why essentially is interest paid out. So if we see that if there is a person who lends money to someone else, then first of all, the first factor which comes to our mind is that what if there is a non-payment happening from the person to whom it is lent? Let's say if I lend 100 rupees to someone else and there is a risk that I don't get back that 100 rupees. So that is called as risk of non-payment. So the first factor for because of which the interest is required to be paid is risk of non-payment. Since there is a risk of non-payment, to compensate for that risk, the interest is expected by the lender, and similarly the interest is paid by the borrower. Okay, this is why the first and foremost factor of the interest comes into the picture. So I'm just saying that risk of non-payment for which there is a compensation expected. And the second biggest factor for the interest to be paid out is the inflation. Or we can say that time value of money. Now to explain this, for example, today using 100 rupees, we are able to purchase one basket of goods. Correct? One standard basket of goods. But this is year 0, for example, which is today. Now, if we talk about the end of the year, which is year 1, so the same basket of goods will cost you around 120. Correct? This is what the inflation is. The inflation is the general increase in the prices or decrease in the value of the money. The 100 rupees was able to give you one basket now is now only be able to give you 120 rupees in year 1 will be able to give you the same basket. Correct? So that means there is a 20% inflation that has happened. Correct? For this inflation also, or we can say the time value of money also, the interest is expected. That is the second reason why interest is paid, to compensate for inflation or to compensate for time value of money. Correct? So these are the two main factors because of which there is a interest amount arises. Correct? And the risk of non-payment is actually something which is governed by the credit rating agencies. Now, what does this credit rating agencies do is, now this credit rating agencies will help the lender or the person who is going to invest in analyzing the basically security in which they are going to invest. And from there, they will come to know that what is the risk of non-payment that security is having. And hence, if the risk is high, the compensation will be higher. Correct? If the risk is high, the point what I'm trying to make is the risk is high, the interest expected would also be higher because they will expect a higher compensation for the higher risk undertaken. Correct? And if the risk is low, automatically the interest will be lower. Correct? Similarly, for inflation also, what is the general expectation on inflation? If it is, let's say, 8%, 9%, so at least the interest that will be kept would be 8% or 9%. Correct? Now, keeping all these things in mind, we can conclude that interest, first of all, is not a constant. It's not a static term. It keeps on changing. Correct? Because the risk today of non-payment is not there, but tomorrow it can be because of, let's say, some business cycle. Because the business is going through a tough phase, the risk of non-payment arises. Or let's say there is an inflationary pressure in the economy. So what I'm trying to say from this discussion is, first of all, interest is dynamic. We can easily conclude that interest is dynamic. Now, if the interest is dynamic, that means the changes in interest might have an impact on your financials, correct? Now, first of all, let me explain the dynamicity as well. So, for example, if we talk about any economy, correct? In an economy, there are interest rate cycles. Interest rate cycles. So interest rate cycles means that in one cycle it will go up and in another cycle it will come down. For example, if economy is growing, if the economy is growing, that means in the economy there is a inflation pressure. The inflation will go up if the economy is growing, correct? And if the inflation will go up, then interest rates, what our central bank will do, RBI will increase the rate of interest so that the time value of, so that the credit becomes costlier in the market, correct? If let's say earlier we were paying 8%, now after rising the interest rate, we are going to pay 10%, then less people are going to take that loan on interest, correct? So the credit will become costlier in the market. Once it becomes that, then automatically the lower credit availability in the market, correct? Or lower credit demand in the market will happen. Lower credit demand, correct? People will less demand now, and hence the inflationary pressure will ease down. Now, what if the economy is going down? In that case, there is a falling inflation, we can say. There is a falling inflation and there is a need to stimulate the economy, correct? So hence the interest rates will be lowered down to stimulate the economy, because once the interest rates are lowered down, more number of people will take credit and do the investment in business. And once the investment is done, then automatically the economical cycle will be restored and the economy will revive from the downfall. Now, these two also indicates that there is a general impact on interest, correct? Because in this case, the interest will go up and in this case, the interest will go down. So definitely we can say that interest is dynamic because the economy under which it is operating is going through interest rate cycles, correct? Now, this is from the macro standpoint, correct? Now on a micro level, how does this interest impacts us? So if you see the balance sheet, I'm just making the old T form of balance sheet and P&L here, correct? Balance sheet. So you have some of the assets and some of the liabilities, but those assets and liabilities are actually interest impacted. What does we mean that by this is, if the interest rate goes up, the valuation will go down. For example, in the bond valuation, we would have seen, and even in the equity shares or the other securities, we would have seen, if the expected rate of interest goes up, the value of the security will go down. So this is the value and this is the interest. Similarly, if the interest rate goes down, the value will go up. They both have inverse relationship, correct? Similarly, in the P&L, if the interest goes up, then there is a line item called net interest income, correct? This will also go up because if there are certain assets on which we are earning the interest, and suddenly the interest rate increases, the net interest income in the P&L will go up. Similarly, if it goes down, then the net interest income will also go down. Correct? This is a generic thing I'm saying because it depends on how your assets and liabilities are there. This we will cover in detail in our gaps exposure. But as of now, what I'm trying to say is there can be vice versa impact as well. If interest goes up, net interest income might go down if your liabilities are more than assets. But that part we will cover in gap exposure, I'm again telling. But what I'm trying to say from here is that any changes in the interest, correct, will have two impacts. One is the on the valuation of the assets and liabilities sitting in your balance sheet, and second is it also have an impact on the P&L through net interest income. Correct. Now, if there is an impact on financials because of the interest rate changes, don't you think there is a need to manage the interest rate risk? Correct. Because if it is going to impact your balance sheet and P&L, hence we have to manage that risk. What is the risk here? The risk of interest rate going up or down. So the risk is clearly interest rate risk, that is the changes in the interest rate. And the changes in the interest rate can happen due to multiple reasons that we have seen. The biggest two factors is inflation, for which the interest is paid, and second one was the risk. Correct? But due to anything and everything, the changes in interest rate can happen, and this will lead to the impact in your balance sheet and P&L. Correct? Now, with this, there are certain types of interest rate risks, correct? Which we are going to cover in our theoretical part of the session. Let me first go to what are the techniques of managing the interest rate risk. Because till now, it is we can conclude that the interest rate risk management is required to mitigate the impact of changes in the interest rates. Simple. Namita is asking, sir, on what parameters RBI is growing or going down? Definitely on GDP, on other things, Namita, RBI would have a lot of data through the statistical means, not only GDP, but a lot of other things. Right? For example, per capita income, for example, GDP, GNP. Through these things, they will determine that, okay, the economy is growing, and even through the inflations, the inflation's index, they will conclude that, okay, the inflation is rising and hence there is a need to lower down the interest rates. Correct? Yes. So that will also change the interest rates. Correct? Once the interest rates are changed, the market interest will also go up or down according to that, and hence there is a risk sitting in your balance sheet and P&L for those assets and liabilities which are interest dependent, or let's say which are interest impacted. Correct? Now, for example, let me give you one example so that the understanding is a bit stronger. For example, there is a housing loan. I'm talking about a bank here. This is called as, let's say, Bank A Limited. Okay. Bank A Limited have given a housing loan, correct, to a lot of retail borrowers, because housing loan is given to the individuals like you and me, correct? They have given a housing loan, and what they have done is they have linked the interest rate to the central bank's rate plus, let's say, 10 basis points. So let's say they have so they have linked it to some kind of a base rate plus 10 basis points, 0.10, correct? So what will happen is now whenever this base rate goes up, the income for the bank will also go up, because this housing loan for a bank is an asset, because they have extended the loan, correct? It's not a borrowing. If it is an asset and the base rate is going up, that means the interest rate is going up, bank will have a higher net interest income. But so this will mean it have a higher interest income. correct? But if the interest rate goes down, that means the bank will have a lower interest income, correct? So clearly there is an impact on the P&L of the bank, correct? And hence there is a need to manage the increase or decrease of the interest rates through the techniques that we are going to discuss now. Okay, students? Now, first of all, what are the different techniques of hedging interest rate risk? So hedging is nothing but a protection, correct? By going through the term hedging, we can just simply say that we are going to protect ourselves, hedging from the interest rate risk. This is called as hedging, correct? Now, as per our curriculum, there are two methods that are given. One is the traditional method, and the second category of methods is the modern methods. There are some traditional methods and there are some modern methods. Okay. Namita is asking, sir, is it necessary that if economy is growing, then inflation will increase? I'm not an expert in that, Namita. I won't be able to comment on that. Correct. But the general idea is that if the economy is increasing, definitely there are chances that inflation is going to go up. Correct. I just took those examples to fit into the macro discussion that we did here. Correct. But that's not what we are going to elaborate. But let us try to focus on the interest rate risk itself. Okay. So the traditional method says that there are further two types of methods. One is the assets and liability. Correct. There are assets and liabilities method, which we call as ALM method, and then there is a second method called forward rates contract or agreements, which we call them as FRA. Then in the modern methods, there are three types of techniques that are there. One is the interest rates futures, interest rates guarantee or option, by whatever name we can say, interest rate guarantee or interest rate options. And the last one is swaps, interest rate swaps. Okay. Now, students, if you see, this is the first method, ALM, second method, forward rate, third is futures, fourth is options, and fifth one is swaps. So there are 5 methods, 2 under traditional and 3 under modern methods. Correct? We are going to study each and every method in detail, and we will try to cover as many questions as possible for each and every those methods, so that the understanding is very clear. But I hope all of you are carrying that why there is a need to study the interest rate, or why there is a need to manage the interest rate risk, because it will definitely have an impact on your balance sheet and P&L. Correct? It will have an impact on the valuation in balance sheet and the net interest income in the P&L, any change in the interest. Correct? Now, the first method is a very easy method, correct? And this approach is basically adopted by a lot of banks as a result of the statutory means as well, and even a lot of non-banking financial corporations as well. So what we say in this asset and liability method is or asset and liability management, we can say asset and liability management, ALM. So this says that, for example, you have different types of assets and liabilities, correct? And assets are to be realized and liabilities are to be paid. Hence, they are called assets and liabilities respectively. Now, since assets are to be realized, they will be realized on a certain date, correct? And liabilities are to be paid on a certain date, correct? So what this says is that matching the assets maturity with the liability maturity. So this means that matching your timing of cash inflows and outflows. So if you match the timing of cash inflows and cash outflows, if you do this, then there is no risk that can happen to you. Okay. So this is basically one part or one method that is there. This is very easy, nothing but how you have to devise all your liabilities and assets is that if you are going to realize after one year EMI of the housing loan, let's say bank is going to realize, then bank also will have to structure its liabilities in such a way that it is using that one year of EMI or one month of EMI to pay off its liability. In that case, the impact of the changes in the interest will be lesser, or we will be able to hedge against it. Okay, now let's come to the second main part of the techniques, which this one is really very important, and we will spend good amount of time on this. The second part is the forward rates agreement. Now, I want all of you to please listen very carefully. What are these? So first of all, students, I want to clarify the meaning of certain terms. Okay, many of you might be knowing this. What is called as LIBOR, correct? So this is nothing but London Interbank Offered Rate. Similarly, MIBOR is Mumbai. Then again, Interbank Offered Rate, correct? There can be anything. Now, what is the meaning of this? So, students, if you see that there in the banks, there is a separate parallel market that is running, okay, in which people like you and me cannot participate, in which companies like other than banking corporations also cannot participate. That is called as interbank market. Interbank market. Okay, in that only banks can operate, because it is named as interbank market. Only banks can operate, and banks lends and borrows money in that market at certain rates. That rate is called as LIBOR, which is the average of all the deals that happens. Okay, this is the average rate of all the deals that happens, because banks will deal in their own way, correct? Bank A, Bank B, Bank C, all of them will borrow and lend the money at certain percentages. All of them are average out to find out LIBOR. Similarly, MIBOR for Mumbai. So all the deals that happens in Mumbai between the banks, it is called as MIBOR. But these are too strong enough, or what I can say, that the interbank offered rate is a strong enough indication that what is the general interest rate happening in the market, correct? Because these are the average rates. So this is the first part. I want you to just have this understanding clear. What is LIBOR and MIBOR? Okay. Yeah. So Namita is asking, sir, why banking need to manage the interest rate risk? This balance sheet does not contain bonds. No, Namita. Its balance sheets contains a lot of assets and liabilities which are influenced by the interest rate risks. For example, this housing loan I told you. If there is a housing loan and it is linked to the, because see, generally housing loan is for 15 years, 20 years, 25 years. And banks, what they do is they don't link or they don't block the percentage as fixed percentage. They always try to enter into a floating percentage borrowing or lending, correct? Because if the term is high, see, for 1 year, 2 year, 3 year, for a car loan or vehicle loan, bank will fix the percentage of interest itself because it is a very short term thing, and bank will be able to manage that. But if there is a housing loan of 15 year, 20 year, 25 years, if that is the tenure, they will not fix the percentage. They will keep the percentage as floating. And floating means it is linked to the base rate. Correct? So hence I'm saying that banks' balance sheets have a lot of assets and similarly liabilities also. If they have done any borrowing for long-term basis, that is also linked to a floating percentage. Correct? And similarly, bonds also can be there. Correct? If they have invested into bonds, if they have invested as an asset, it will be appearing. If the price, if the interest rate goes up, valuation will of bond will come down. Okay, Namita. So it is actually banking industry is the industry that needs interest rate risk management the most, because they have a lot of assets and liabilities that are influenced by the interest rates changes. These we are talking about the floating assets, floating based assets and liabilities. Okay, Namita. Now coming back. Now this forward rate agreement, we were first of all I have elaborated this LIBOR and MIBOR. I think these are the two terms, correct? That would be very clear to you. Now this is nothing but just an average rate on which the deals are happening between the banks, only banks as participants in the London or Mumbai. Okay. So Namita, base rate is, for example, LIBOR only. Okay, base rate I have just taken. That now this base rate can be any rate. Okay, it can be, for example, if you talk about SBI, so SBI will have its own base rate. Correct. Similarly, if they want to base this on MIBOR, they will use the base rate as MIBOR. Okay, or on LIBOR, they will use the base rate as LIBOR. Base rate can be any rate which is an outcome of certain things in the economy or in the bank. Okay, base rate is anything. It can be LIBOR, MIBOR, it can be an internal number, or it can be any number which is published by RBI also, Reserve Bank of India as well. Correct. So I'm just using the base rate term here to say that there is some rate that we are going to base upon our deal. Okay. Now this is the first part. Second part. Now, for example, there are two banks. Okay. Now see the kind of requirements these banks have. Okay, there is a bank A and there is a bank B. Okay, students. Now the bank A has a need. Now bank A has finalized and it has come up using its cash flow projections that bank A would be needing to borrow, after 1 month from now for 3 months time period, rupees 1 lakh, for example. Now, what does bank A say? That bank A, through its cash flow projections, have come to a consensus that bank A needs to borrow 1 lakh rupees, not today. It is not today. They need to borrow 1 month from now. Okay. For example, we are in January. They need to borrow the amount in February. Okay. For a period of 3 months, which is Feb, March, and April. Correct. So till April, they will borrow, and then on April, they will repay the amount along with the interest. This is what bank A is saying. Now, what bank B is saying is, okay, bank B through its cash flow projections comes to know that there is a surplus cash that bank B will have after 1 month from now, not today, but there is a cash flow projection. Banks can easily do cash flow projections basis the cash flows that are already contracted because there are proper agreements for this. So what bank B need to do is need to invest after 1 month for 3 months. And bank B also says that I will have this 1 lakh rupees of surplus amount to be invested after 1 month, but that would be available for 3 months only. Because after that, I again need that money back because of some of the other reasons. Correct? And they are also willing to invest this 1 lakh rupees for 3 months after 1 month from now. Correct? Now, what does both of these banks are thinking? They are saying, okay, we come to know about certain requirement as on today, and we don't know what is going to happen after 1 month because we are going through interest rate cycles. Our economy is going through interest rate cycles. We don't know where the economy is going to end and where the interest rates are going to end after 1 month because the economy is clearly fluctuating. But what we know is that the current interest percentage is 5% per annum. What banks know or what certainty today bank have is that the current interest rate is 5% per annum. Bank A stipulates that the analysts that are sitting in bank A, they analyze and say that, okay, today current interest rate is 5% per annum. You need 1 lakh to be borrowed after 1 month. We anticipate that there is going to be an interest rate increase, and it will increase to more than 6-7%. That is what they are stipulating. Now, what is the solution available with bank A? So bank A says that today current interest rate is 5% per annum, and I know that the interest rate is going to go up, correct? And it will go up, let's say 6%, 7%, 8%, that the analysts are saying. What should I do so that I am rest assured today only that this is going to be my borrowing rate? Bank A approaches bank B. Again, let's say in their offline market, correct? Now, what bank B says is, okay, I have surplus cash. I am willing to invest for 3 months. They say, okay, but we need to invest after 1 month. This is what also bank A says, that I need to borrow after 1 month. Both of their conditions and terms and conditions matches. Now the negotiation will happen on what interest rate. Since the deal is happening today, they can't say that whatever is the interest rate happening after 1 month, we will do the deal on that. That's not the essence of transaction, because if that is going to happen, then bank A need not do all these projections of the cash flows. Whenever the requirement comes, they will go and borrow from the outside market at the open rate. But since the essence of this deal is both of them want some kind of a security and want to lock the rate of interest. So what both of them agree is, okay, we agree for a forward rate percentage of 6% per annum. This will be applicable for the borrowings and investments after 1 month for rupees 1 lakh for bank A and for bank B respectively. After 1 month. What both of them have done is, both of them have secured their interest expense and their interest income. So there is an interest expense for bank A, and bank B there is an interest income at the rate of 6% per annum. Now in the open market, after 1 month, it can be 7%, 5%, 4%, 8%, it can be anything, but they will close down their deal at 6% per annum. Both of them are protected against any increase or decrease in the rates. Okay. Now, Namita is asking, sir, who is saying that the interest rate increases to 6? So Namita, bank A internally would have some kind of analysts, would have some kind of people who will project that what is going to be the bank rate in future. So they are suggesting to the board of bank, or let's say to the decision makers of the bank A, that the percentage is going to increase in future. Okay, so bank A internally is going to do that. Correct. Now, just to note this, let's say today is a 0 day. This is the 1 month. Correct. So today the deal is being entered. But students, do you feel that today itself they will borrow and lend? No, they have just entered into a deal that they will borrow or lend after 1 month. This is where actual borrowing or lending will happen. Correct? At the rate of 6% per annum. And that borrowing or lending will happen for 3 months. So this is going to end at fourth month. Fourth month I'm writing because first month is the month where they have already entered, and then from first to fourth, this is the 3 months duration for which the borrowing or lending will be applicable. Okay. Now, using this, there is a standard notation of FRA. Okay. We call this FRA as FRA 1/4. Okay, this is the standard notation. For example, now in this one is 1 month from now, the deal is going to get executed, and till fourth month from now, it will go on. Fourth month. So duration will be 4 minus 1 is equal to 3 months. Correct? So 3 months is going to be the duration of the deal. Deal means from the day once it is actually borrowed or lent to the day it is matured. Now, for example, there is a FRA of 3/6. What does this mean? This means that third month the deal will be entered, correct? For duration of 6 minus 3 is equal to 3 months. So 3 months from now, the deal will happen. The transaction will happen. Deal has happened today only. The transaction will happen 3 months from now, and the duration of the transaction will be for 3 months. Okay. Okay, students. Now, for another example, just for clarifying, I'm saying it is 3/9. So that means third month, the actual borrowing or lending will happen, but duration is for 6 months, which is 9 minus 3. Okay. Yes, Namita. So Namita is asking again a very good question. Sir, is it possible that cash flow projections of both the banks may not become reality? That's very much possible. And that is where another risk comes into play. Correct? We are going to study those types of risk in the theoretical part of the session. So there are chances that the cash flows will not come as what we have desired. Okay. Now, in the same example, they have entered into a deal at 6% per annum. Okay, students. Now, what will happen? Let's say at the time of first month, correct, where the lending and borrowing is happening, or we can say that on settlement. Now, interest rate can be, I'm taking, there are 2-3 scenarios that I'm taking. Let's say the actual interest rate is 8%. Actual interest rate, for example, is 5.5%, and actual interest rate is, for example, 6%. I'm taking these three examples. Okay, as on the first month, while they are actually borrowing and taking, what if the actual interest rate comes out to be the 8%? Okay, so the case one, if it is 8%, bank A would get. Now see what bank A will think here. Bank A will say, okay, I have already a deal to borrow at 6% in the open market. The rate of deal is going at 8%. Don't you think bank A is at a gain? Correct. Bank A is able to mitigate the increase impact very easily and very carefully. So bank A would get 2%. Now, see, the thing is, bank A will say to the bank B, okay, I don't want to enter into an actual cash inflow and cash outflow. I will not borrow the 100,000 or the 1 lakh rupees from you. You just give me the differential of this 8% and 6% as 2% on the 1 lakh rupees as a FRA result. Correct? Because FRA, if it is, again, we have studied in the futures and options as well, that if the settlement happens on gross basis or on net basis, if it happens on gross basis, then the delivery will also happen and the payment will also happen. But if it is happening on net basis, that then only the differential is being paid by the losing party to the winning party. Here the winning party is bank A and the losing party is bank B. And bank B would pay 2%. Now, how the calculation will happen, students? See, now how the calculation will happen is, yeah. So, on 1 lakh rupees, 8% minus 6% multiplied by 3 months, because this 8 and 6% are both of them are annual percentages. Okay, so what they will say is that, okay, we are going to pay 2%. Bank B is going to pay 2% for 3 months on 1 lakh rupees, but it is not going to pay after the end of 4th month. They are going to settle it on the first month itself, which is the beginning of the loan. Correct. So hence we will have to do the present value of this amount. So what I have done is 1 plus 8%, which is the actual percentage, multiplied by 3 by 12, which is the time period, because with this they have done the present value. So this is the value as on first month. Correct. So basically as on first month, that is the beginning of the transaction, this is the value. So this comes as 490.19. So this is the net amount that value has to be paid from bank B to bank A in case the actual interest rate is 8%. Okay, students? No, let me take the questions. So Sairam Malesham Gali is asking, good morning, sir, forward rate interest happens in bank only or other persons can also do this? So Sairam, good question. This can be done by any other person also. See, because forward rate agreement is over the counter agreement, correct? It can be customized to any extent. It is not only meant for banks. It can be done by any other person. It can be done by two business corporates also other than banks. It can be done by banks also. Okay, because it is to hedge against the interest rate risks. Namita is saying, sir, banks have screens as we have for stock markets on which bank offers cash availability or cash range of banks. Namita, I think they would have some internal tracking or they would have some internal softwares which will throw them that what is the cash availability or cash requirement for them. Correct? They would have some kind of modus operandi to arrive at it. Now Namita is saying, sir, so banks can enter these type of agreement for speculation purposes. No, Namita. First of all, they can definitely go into the speculation, but our idea to do discussion here is to understand the hedging concepts, not the speculation concept, because we are studying the interest rate risk management. So there is already a risk. For that, we are doing the management. That is called as hedging. Hedging means protection against the risk. But speculation means that there is no risk. Initially, there is no risk. But once you enter into the FRA, you will create a risk. That is called as speculation. Correct? So this we are understanding from the point of view of interest rate risk management. That is the hedging. More from the hedging. Yes, to answer your question, Namita, yes, they can very well enter into this for the purpose of speculation as well. Okay. Now, taking the case number 2. Now, case number 2, we said that what is the percentage? 5.5 percentage. Now, if 5.5 percentage, now what bank A will think? Bank A will say, okay, in open market, after the end of first month, because this settlement or the actual rate will happen after the end of first month. Now, what bank A says that, okay, in the open market, I would have got the loan at 5.5 percentage. Under this agreement, I have to pay 6 percentage. Don't you think bank A is in a losing party side? Correct? Because bank A would have easily got 5.5 percentage from the open market. But had this fact known to the bank at the 0 month, bank would have not entered into this. But bank have entered just to protect itself. But because of this entire arrangement, bank will lose 0.5 percentage. Bank A would lose 0.5 percentage, which is 6 percentage minus 5.5 percentage. And bank B would gain 0.5 percentage, because the loss of bank A will be a gain of bank B. Correct? Now, bank B will say, in the open market, I could have invested at 5.5 percentage, but through this deal, I am able to invest at 6 percentage. Don't you think it is a gain for bank B? Yes, there is a gain for bank B. Now, how does the calculation will happen? Calculation will happen again on the day of settlement, which is the first month. They will take the present value. First of all, they will calculate the differential, 6 percentage minus 5.5 percentage, but for 3 months, correct? This whole divided by 1 plus 5.5 percentage multiplied by 3 by 12. Now, again, students, please note, we are always using the actual exchange rate to do the present value. Okay. So this comes as 123.31. Okay, students. So in this case, bank A would pay. Now coming to case number 3. Case number 3 is 6 percentage, and the agreed rate is also, the FRA rate is also 6 percentage, actual rate is also 6 percentage. So there is no payoff. Both of them are at equal position. Correct? So with this, can we say that our formula to calculate the payoffs, correct, would be N, which is the notional amount. This notional amount is 1 lakh rupees, correct? Now this notional amount is the amount of loan that they want to enter. RR minus FR divided by this whole multiplied by T, 1 plus RR multiplied by T. Okay. So where N is equal to notional amount. Notional amount in our example was 1 lakh rupees. RR is equal to the actual rate, actual interest rate. FR is the forward rate, forward interest rate. This is governed by the FRA, correct? And T is equal to the time period of loan or slash borrowing or slash whatever is the transaction that is going to happen. This is the time period. Okay, so this is the formula. Please note it down. Sairam is asking, interest rates are also applicable for bonds which is issued by the companies or banks. Yes, Yes, Sairam, it is very much applicable. Even if these are applicable and there is a change in the interest rates, those will change the value of the bonds as well as the interest payment or interest receipt on the bonds also. It is very much applicable. Namita is saying, sir, in this open market, interest rate is changing daily in 3 months period of agreement. Okay, Namita, we will introduce that complex situation as well. Okay, Namita. So, Namita, again, you're asking one more good question in which you are saying that what if the open interest market rate changes within these 3 months? So that situation is also what we are going to cover it. Correct? Okay, Namita, that is called as OIS, overnight index swap. Okay, that we are going to cover. Sairam is asking, in India, we considered the MIBOR or LIBOR for interest rate calculation. So, Sairam, it depends on what type of deal that they are entering. Generally, definitely they will prefer MIBOR, but even if let's say the deal is going to execute in London, then they will prefer LIBOR. Correct? It can be anything. It can be anything other than LIBOR or MIBOR also. So don't restrict yourself only to LIBOR or MIBOR. And those are just two examples how the interest rates are arrived on the interbank markets. Correct? Because see, what are the different factors? One is the interbank market. Second one is RBI, because RBI will also come and they will also, specify their own interest rate policy, the monetary policy that comes. Then even a bank like SBI can also internally have their own base rates, correct, on which they base all the calculations of interest. So as of now, the interest rate calculation can happen on any index, on any average. Okay. Now let's come to the question number 1. So this is from the assignments that have been uploaded. So, okay, before we come to the question number 1, the last point in this that I want to say is the now we are talking some technical terms, bank A and bank B. Since bank A wants to invest, wants to borrow, correct, wants to borrow, we call this as purchase FRA. Bank A is purchasing FRA, or we can say that bank A is having a long position in FRA. Similarly, bank B. So he is into the borrowing position, correct? The one who has to borrow is in the long position of FRA. The one who is going to the one who is going to invest, we say that he is selling FRA. Or we will say that he has done a short position in FRA. Correct? And our above example also tells us the same thing, because in this case, if the interest rate goes up, bank A will gain. Correct? That's how we have studied in our derivative segment as well. That long position holders means if the price of the security goes up, definitely the holder will gain. Similar, or the person who has a long position will gain. If the interest here goes down, the bank B will gain. Correct? This is what the short position holder has an impact into. Naveen is asking, going by the formula, FRA is settled in the beginning itself and not at the end of the contract. Yes, Naveen, that's right. Naveen Prakash, your understanding is right. It is settled at the beginning itself because we are doing the present value here. But sometimes question indicates that you have to calculate the settlement at the end. Then you are going to calculate the settlement at the end. Okay. But generally, we will say that, okay, it is settled at the beginning of the period itself. Okay. Not at the time of zero period, but at the time once the FRA deal starts. Correct? Now, coming to question number 1. Messrs. Parker and Company is contemplating to borrow. First of all, it is saying borrow. Borrow means they are going to take a long position in FRA, or they are going to purchase FRA. Okay. An amount of 60 crores. 60 crores is our notional amount for a period of 3 months. T is equal to 3 months in the coming 6 months time from now. So what is this FRA being quoted as? FRA 6/9. Correct? So 6/9 means duration is equal to 3 months, and it will start from 6th month. Correct? The current rate of interest is 9% per annum, but it may go up in the 6 months time. The company wants to hedge itself against the likely increase in the interest rates. See, they know that the current interest rate is 9% per annum, but it might go up in the 6 months. The same example that we have studied till now, correct? Only the numbers are a bit changed. The company's bankers quoted an FRA of 9.3% per annum. They are saying that, okay, today's rate is 9%, FRA rate is 9.3% per annum. What will be the final settlement amount if the actual rate of interest after 6 months happens to be? Now, see, students, the question here is indicating that after 6 months, that means at the beginning of the period, correct? It will be 9.6 and 8.8. At that point of time, we have to calculate the settlement amount. So Naveen, we are here required to calculate in the beginning itself. That means, correct? So I'm just plotting here 0 month, 6th month, and then 9th month. 3 months is what the borrowing period is. Okay, students? Now, the FRA rate is how much? FRA rate is 9.3. The actual rate is 9.6. We have taken a long position. Messrs. Parker and company has taken a long position. They will gain, okay? Because the interest rate has gone up. So 60 crores multiplied by 9.6% minus 9.3% for 3 months divided by 1 plus 9.6% for 3 months. This is what we are doing as a present value. So if we solve this, it comes as rupees 0.0439453 crores. So Sairam is asking that in forward contract, company is supposed to maintain in margin account. Now, Sairam, since this forward contracts are over the counter contracts, now you can compare these forward contracts with in the derivatives session, we have studied forward, futures and options. So forwards were over the counter, futures were traded on exchange. So margin requirement came in futures and options, which are traded on stock exchange. But forward, since these are over the counter, these are not traded on stock exchanges, hence there is no need of margin. But still, if some party wants some kind of security in the forward contract also, so in the contract itself, they can agree that this much of margin has to be kept in some kind of a escrow account. Okay, so that the other party does not fail. You're getting my point? So there can be practical possibility that they will enter, but again, it depends on the mutual discussion or the mutual agreement, correct? Because it is over the counter. Now, the second part, it says is, if it is 8.8, in case if it is 8.8, so I'm just saying that this is a gain, okay? Now, in case of second case, 8.8%, then there is a loss, correct? Why? Because we have taken, the Parker and company have taken a long position in FRA. Parker and company said that, okay, I have a agreement through which I can borrow at 9.3%. But in the open market, the rate is going as 8.8%. So Parker and company will say, okay, I have incurred a loss here. I am not at a gainful position because what I'm able to get here, this is not at all an advantage for me, correct? So it will be 60 multiplied by 9.3% minus 8.8% multiplied by 3 by 12, okay, divided by 1 plus 8.8% multiplied by 3 by 12. So what does this amount comes out to be? 7,33,855. rupees. So here Parker and Company will pay rupees 733,855. They are at loss. Okay, students. So very easy and very simple question. I have done this not in a very fair presentation, correct? But I just wanted to run through this portion, hence I did this. But you can write it very easily. First write the formula, then write the solution, and then write the final conclusion here, correct? Show the calculation and do the final conclusion. Namita is asking, sir, if the interest rate changes monthly, that is 3 times in agreement period, then how settlement only at the beginning of first month? It should settle. Okay, so Namita, as of now, again, as I'm saying that yes, you're right that the interest rate can change even 3 times in 3 months, or it can change daily also. Okay, we will consider a situation where we will cover the daily changes in the interest rates also. Correct. But as of now, we have just started. Hence, at the start itself, we are just going through the simple problems first. Correct. We will introduce those complexities into the discussion where the interest rate does not changes even monthly, even if it is changes on a overnight basis, on a daily basis. Okay. Then also how we have to tackle those situations. Okay, Namita. Let's go to the question number 2. Now, students, question number 2 says TM FinCorp has bought a 6 by 9 FRA of rupees 100 crore. Now, 6 by 9 means 6 month it will start, and for 3 months it will be there. And the rate is 5.25% on fixing date. Reference rate, that is MIBOR, turns out to be. Now, here is MIBOR is mentioned. Don't get scared again. It's just a reference base rate here. 3 months, 6 months, 9 months. So they are saying that what is the reference rate? So let's say 0, 6, and then FRA is for 9th month, correct? 6 by 9. So that means duration is 3 months here, correct? This is the period for which the FRA will be operational from 6th month to 9th month. That means T is equal to 3 months. And this is called as fixing date or settlement date, whatever we can call it as. Settlement date, fixing date. Generally, this is called as this. Okay. Now, one more thing, the MIBOR or LIBOR that we have studied is actually for different types of maturities, correct? For example, there will be 10 different types of LIBOR that would be operating, or 10 different types of MIBOR that would be operating. For example, the first one will be for 1 month, 2 months, 3 months, 4 months, 5 months, like this. So this will say that if time period is equal to, now I'm taking this example, if there is a borrowing happening between the banks in Mumbai intermarket for 3 months duration, the rate of interest is coming out to be 5.5%. If they are borrowing for 6 months time period, the rate of interest is a bit higher, which is 5.7% per annum. Okay, so this is what they are trying to say, or that is how practically it happens. So depending on the duration of the agreement, sorry, duration of the loan, they will specify that what is the MIBOR actually is. Okay, students. So for 1 month there is a separate rate going on. For 2 months there is a separate rate going on. 6 months separate, likewise. So here also they have given 3 different types of MIBORs. So our FRA is for 6 by 9. Duration is 3 months. These two are not useful at all for us. These two are given as additional information, which is not making any use to us. Correct? Now, you are required to determine the profit and loss to TM FinCorp in terms of the basis points. Correct? Now, if they have entered into an FRA of 5.25 and the 3 months MIBOR is actually what? 5.5. They have taken a long position. They have purchased the FRA, correct? If you see, has bought, that means they have purchased the FRA. They have taken a long position. After taking a long position, the actual rate is higher than the FRA rate. That means there is a gain, correct? So gain to PM FinCorp is equal to 25 basis points. Bips, 25 basis points. Why? Because there is a 0.25 percentage gain, correct? So there is a 25 basis points gain from 5.5 to 5.25. Okay, now the second part, the settlement amount. See, now they are saying us to calculate the settlement amount, which is can be calculated using the formula. So we have 100 crore of amount multiplied by 5.5 percentage minus 5.25 percentage for 3 months. This whole we will do the present value. Present value will always be done at the actual rate, which is 5.5 percentage multiplied by 3 by 12. Okay. So this will give us the amount of 6,16,523. So profit 2. Okay, student, one mistake that I did here is instead of taking the 3 by 12, since in the question it is mentioned, assume 360 days in a year, we will denominate it in the number of days. 90 divided by 360. Okay. No, Harshad. Okay, let me just take the query. Sir, we will take MIBOR of 6 months. No, Harshad. See, uh, so this period of 3 months, 6 months, 9 months does not mean that it is the basically it is this time period. No, it does not mean it. It means that what is the time period of the actual borrowing? Actual borrowing will happen from 6th to 9th month only, correct? That is for 3 months. Hence, the reference rate of 3 months is suitable to us, which is this 5.5. Okay. 6 months, our agreement is going to start. The borrowing is going to start from now. 6 months and 9 months has no relevance to us. Okay. Okay, Ashad, I hope this point is clear. So we will only refer to the 3 months. So the profit to TM FinCorp is equal to 616,523 rupees. Okay, students. Let us come to the valuation of FRAs. Okay, which is the forward rate agreement. Now, students, if you see, till now we are given that this 5.25 percentage is the FRA rate. Now, how to calculate this 5.25 percentage? We can also say that this is a theoretical minimum price, or I can also say that it is a arbitrage free price, correct? Because at this price, the arbitrage is not possible. The same thing that we studied in derivatives under the forwards and futures, correct? That time we studied what is the theoretical minimum price, and the same thing is called as arbitrage free price, because at this price there is no arbitrage possible. Now I am taking an example of FRA 3 by 6 0 3, and then here is 6 months. Oh, no, Harshad. No. So Harshad is saying that he thought that it is after 3 months, the rate will be 5.5 and so on. No. I think, okay, I understood from where the confusion arises. But that confusion, Harshad, if you read this thing carefully, period. What is the period? And second indication that gives us is on fixing date reference rate is MIBOR. Turns out to be. Okay. So Naveen is saying, sir, can we assume that 5.5 is for 3 months and not 3/12 because they have given 3% month? Okay, Naveen. So I got your point. See, it would always be rational. See, if you say that for 3 months it is 5.5 and for 6 months it is 5.7, that does not sound rational assumption, correct? Because if it is generally 5.5, it should be almost around 11 or more than 11 or less than 11, around 11%, correct, Naveen? So it's better to assume this as a percentage per annum only. All of them, even this also, percentage per annum only. Okay. Namita is asking, sir, in formula, why we are multiplying with time period, then again calculate its present value. Why is it so? So, Namita, this is what we have studied earlier because, see, in the formula, if you see, the numerator is actually giving us the actual gain or loss, correct? This is the interest rate changes. And using the denominator, we are actually doing the present value of the gain or loss. Gain/loss. Because see, if you just simply calculate the gain or loss, that will mean that this is the gain or loss towards the end of the period, which is the 9th month. This is FRA 6/9, right? Yes. So this will mean that it is a gain or loss at the end of 9th month. But we have to calculate the gain or loss at the end of 6th month, which is the starting of the time period. Correct? Okay, Namita? Now, coming to the valuation of FRA, I have taken an example of FRA 3/6. Okay. Now, students, if you see, we know that, for example, we will know that what is the interest rate for 6 months, correct? For example, 5% I have taken. And what is the interest rate for 3 months? These two things will be known to us, can be easily known. For example, if I take LIBOR as on today, which is 0 day, okay? LIBOR as on today, which is 0 day, if we know that LIBOR for 6 months borrowing is 5%. Similarly, LIBOR for 3 months borrowing is 4%. We know that for different maturity periods, what is the different LIBOR, correct? Can we calculate the interest rate for 3 to 6 months? This is our FRA rate only, correct? Can we, sitting today on 0 day, calculate what is the 3 to 6 months gap? Yes, we can very easily calculate. How? If we assume that this is X%, correct? So what we are going to do is, first of all, we are going to equate 1 plus 5% for 6 months, correct? This is the, let's say, what we say is that we are going with 1 rupee today, what value it is going to have after 6 months, correct? Which is this 1 plus 5% for 6/12. And if we take this route, first we invest for 3 months, and then again, once we get that investment back, we again invest for next 3 months under FRA. Then what is the return we are going to get? So 1 plus 4% multiplied by 3/12 multiplied by 1 plus X% into 3/12. We can say that this is that theoretical equation that will give us the same proceeds if we take this route of 6 months or if we take the 3 months route, 3 plus 3 months or 6 months. Any route we take, we would be indifferential if we get X% solving through this equation. This is what FRA is. Simple. Because sitting today, what will be my FRA? If I reach through the direct line, at 5% per annum after 6 months, and if I go through two different sets, now this FRA I have assumed 3 by 6 months, it can be 6 by 9 also, it can be anything. So in that case, we are going to equate 9 months with equal to 6 months multiplied by 3 months rate. Correct? Okay, student. So we are going to cover these examples also, but if we solve this, then X percentage comes as 5.94%. So FRA will be quoted the theoretical minimum price or the arbitrage free price for the FRA 3 by 6 will be 5.94%. Okay, students. Now see the actual scenario. For example, FRA is actually available at, now see, as we have studied that in forwards also, in while studying forwards on an equity share, we studied that there is a formula to calculate the forward price. That is nothing but the present value and future value that we do, correct? That is just a future value. Now using that, we will come to know that, okay, 100 rupees is the forward price. Now actually in the market, I am talking about futures, for example, not forwards, leave behind forwards, futures, the theoretical price comes as 100 as per the calculation, but in the stock exchange, the same future is being traded at 90 rupees. Correct? It can happen because 100 is just a theoretical price through this equation that we have been able to calculate. What are you going to do? You are going to definitely purchase that future. Why? Because the future is underpriced. That is a proper logic. And if it is 110, in that case, you are going to sell the future because it is overpriced. Same thing we are going to do here. If the theoretical minimum price is 5.94, but FRA is available at lower than 5.94%, then what you can do is you can take a long position in FRA, or you can purchase an FRA, or I can say that you can borrow through FRA. And in this case, you know what will be the arbitrage opportunity will be 0, 3 months, 6 months, correct? So what you are going to do here is you are going to borrow here. You're going to borrow the FRA. That means you have to borrow here as well. Correct? You have to borrow here as well, and you will invest here. See, now I'll tell you, the strategy says that if the FRA is available less than 5.94%, then what is the arbitrage strategy here? The arbitrage strategy, see, first of all, okay, let me say that if actually the FRA is available at 5.94 only, let me explain through the negatives. Okay, so if the FRA value is 5.94 only, there is no arbitrage possible. No arbitrage. Correct? Because as per our formula also it is 5.94. But if the FRA is available less than 5.94, then it is recommended to borrow through FRA because the FRA is underpriced. And what we do in case of underpricing, we always take a long position for anything which is underpriced. Long position means we will borrow through FRA, correct? That I have already clearly told. Okay. Hence, if we are going to borrow here, correct? using that borrowing, we will repay the first borrowing. This is, let's say, borrowing 1, borrowing 2. We will go and repay the first borrowing, and using the first borrowing, we will invest for 6 months. Simply. Okay. This will give us arbitrage gain. We will understand better through the question. Okay. Now let me take the case 2. This is case 1. Case Hello. Am I audible? Welcome back, students. There was some technical issue. So what I'm just going to repeat what I repeated in last 2-3 minutes. So what I said is that in case of case 1, in the first case, I said that FRA is available at a lower price than 5.94. In that case, we will say that it is underpriced. We will take a long position. That means we are going to borrow through an FRA. If we are going to borrow through an FRA, for the first 3 months also we are going to borrow it. Okay. Okay. For the first 3 months also we are going to borrow it, and using this borrowing we are going to invest for the 6 months. Okay. Namita is saying, say, last diagram, not by taking which loan we will pay which liability. Okay, I'll tell you. See, in this case 1, borrowing 1, let's say you get 1 lakh rupees. You will directly, first of all, invest for 6 months, but you will borrow only for 3 months, correct? Now, after 3 months, you have to repay borrowing 1 loan. Let's say you will have to repay 1 lakh plus interest on that. For example, 1 lakh 3,000 you have to repay. So second borrowing you will do for 1 lakh 3,000, and after another 3 months you will have to repay borrowing 2, for example 1 lakh 6,000. But you have invested this 1 lakh rupees for 6 months, you might get 1 lakh 7,000. You have to repay 1 lakh 6,000. You are having 1 lakh 7,000. That means 1,000 is a gain to you. Okay, Namita. We will understand this again in detail while we will solve the question. Let us go to the case number 2. Now, what this case number 2 says is, if FRA is higher than 5.94%, okay? If FRA available is higher than 5.94%, don't you think that it is overpriced? If it is overpriced, then we will short sell the FRA. By short selling the FRA, correct, we mean that we are going to invest through FRA. Now, how does this diagram will look like? 0, 3 months, 6 months, correct? So in the FRA period, we are going to invest to, for example, That means in this period also we are going to invest. For example, this is investment 1, this is investment 2, and for 6 months we are going to borrow. Simple. So for the 6 months we are going to take a borrowing. For the first 3 months we are going to invest. We are going to get the proceeds. Then another 6 months, another 3 months we are going to invest as investment 2. Okay, this is case number 2. But the indication from here is that what we are going to do is we are going to borrow or invest. That depends what is the actual FRA being quoted at. Okay, students. Now we will do proper in-depth questions for this to understand these points in detail. Let us go to the question number 3rd. Before now, students, if you see, this question says that the following market data is available. Okay, spot USD versus Japanese yen is 116. First of all, they have just given us a quote here. That's all. The deposit rates per annum. Now, see, students, they have already mentioned per annum. If the maturity is 3 months, then it is 4.5 and 0.25 in the respective markets. You only think them, these are two different markets, nothing more than that. Don't get confused. These are two different markets. That's all. Only keep this thing in your mind. USD is a separate market. Japanese yen, which is Japan, is a separate market. 3 months time period loan is currently at 4.5% in USD, and JPY it is 0.25%. Similarly, for 6 months also they have given. FRA for yen is nil. There is no FRA in yen. This information is not at all required. They have just given you to confuse the same. Okay. So FRA, there is nothing in FRA in yen for is nil. Okay. What should be the 3 months FRA at 3 months forward? So first of all, we are talking about here at FRA 3/6. Okay, so because they are saying what should be the 3 months FRA, this is the time period of FRA. At 3 months of forward means 3 months from now. Okay, 0, 3, and 6. Correct? You're talking about this. They have given that this is actually 6 months. USD rate is 5% per annum. 3 months rate is 4.5% per annum. We have to find this. This is actually FRA 3/6, correct? Now, Namita is saying, sir, is it possible that period of investment 1 is more or less than 3 months if other periods remain same? No, Namita. If that is the thing, then our arbitrage strategy will go for a toss. Here you are asking, right? Because the formula or the arbitrage free price is designed in such a manner that investment 1 has to have a time period of 3 months, and investment 2 also has to have a time period of 3 months. Correct? Because in the formula, you are multiplying it by 3 months. If actually investment you are doing only for 2 months, that means your arbitrage is going for a toss. You cannot do that. Okay. Yes. So coming back, we have to calculate this 3/6 FRA. Let us assume this to be the X percentage. Simply, I'm just putting the formula 1 plus 5% for 6 months is equal to 1 plus 4.5% for the first 3 months, multiplying this by X percentage for the next 3 months. Simple. Some of you might be wondering why we are multiplying here. We are multiplying to give the compounding effect. correct? 1 plus percentage for first 3 months and 1 plus interest percentage for the next 3 months. By this, we are actually compounding the requirements here, correct? So FRA 3/6 is equal to, if we solve this, the X will come as 5.44 percentage per annum, correct? So FRA 3/6 is the minimum price is 5.44 percentage per annum. Simple. Students, please note, since we have a limited time to cover a lot of things, I am not doing the proper calculative presentations here, okay? I'm just writing the exact answer. So please keep that in mind, that if you solve step by step, that would be better. Okay. So FRA 3/6 is 5.44 percentage. Now the next part, it is saying that the 6 months and 12 months LIBORs are at 5 percentage and 6.5 percentage. Now these percentage are also in per annum only. Okay, don't get confused that these are the percentage for 6 months and 12 months respectively. No. If the time period of lending and borrowing is 6 months and 12 months, then LIBOR is quoted at 5% and 6.5 percentage per annum only. A bank is quoting a 6/12 USD FRA at 6.5 to 6.75 percentage. Now, students, I think you would have already seen the bid rate and ask rate, correct? So this is nothing but 6.5 and 6.75 is the bid and ask, basically differential. So if I have to purchase from the bank, I will have to pay them 6.75 percentage. If I have to sell to the bank will pay me 6.5 percentage. This is what the 6.5 to 6.75 will mean. The same logic that you would have studied in your foreign exchange management, correct? So if it is 6.5 and 6.75, correct? So I have to first decide whether I have to purchase or I have to sell the FRA. If I'm going to purchase, this rate is applicable. If I'm going to sell, this rate is applicable. Now for determining that, I have to first calculate the theoretical minimum price of 6/12 USD FRA. So FRA 6/12 will mean 0 to 6 months. Then this is the 12th month, correct? This LIBOR for 12 months, they have given us 6.5 percentage per annum. And for the first 6 months, they have given us 5 percentage per annum. Correct? 6.5 percentage per annum and 5 percentage per annum. Can we calculate the FRA value here? Yes. FRA 6/12, how will it look like? So 1 plus 6.5, sorry. So 1 plus 6.5 percentage multiplied by 12/12, because it is 12 months, it is equal to 6/12, correct? 5 percentage for the first 6 months multiplied by 1 plus X percentage for the next 6 months, correct? Using this, if we calculate, X comes as 7.80 percentage per annum. So the theoretical minimum price or the arbitrage free price is 7.8 percentage per annum. Now, if we have to buy the FRA, bank will give us 6.75 percentage rate. The 6.75 percentage per annum, it is available with the bank. The arbitrage free price is 7.8. Don't you think it is underpriced? Don't you think this is underpriced? If it is underpriced, the recommendation is to buy FRA. if we are going to buy the FRA, correct? If we are going to buy the FRA, that means we are going to borrow through FRA. Now it is asking for the arbitrage opportunity available and profit in such a case. So we will say that yes, arbitrage opportunity is available. Yes, arbitrage opportunity is available as the FRA 6 by 12 USD quoted by bank is at 6.75 percentage and theoretical minimum price is at 7.80 percentage, correct? And we will have to calculate the arbitrage gain. So what is going to happen? I'm just depicting it through here. 6 by 12. 6 by 12, this FRA we have borrowed. So I will say that this is a borrowing too. In this period also you will have to borrow. Just remember one thing, students, whatever action you take for the FRA time period, the same action you will have to take for the first, for the this part of the time period also. And then you're going to invest for 12 months, correct? This is what you are going to do. And you are going to invest how much? We let us assume that 1 lakh is the notional amount to calculate the gain or loss. Okay. Now, what will happen? So at the zero period, nothing will happen, correct? At zero period, nothing will happen because whatever we borrow, we will invest. So the cash flow at zero period is nil after 12 months. Now, what will happen after 12 months? Cash inflow from investment will happen at 1 lakh multiplied by 6.5 percentage, because that is the rate that is applicable for 6.5 for the 12 months. So we will get 1,06,500. Okay, minus cash outflow for borrowing. So 1 lakh, first of all, will be for the first 6 months. How much is the rate that will apply? 5 percentage, correct? This is the actual rate of LIBOR, 5 percentage. This will apply 1 plus 5 percentage for 6 months. And the next 6 months, it will be multiplied with the forward rate. Forward rate was quoted as 6.75. 1 plus 6.75 percentage multiplied by 6 by 12, correct? Because for first 6 months, we are going to pay the interest at 5 percentage. Next 6 months, we are covered under FRA. So we will pay 6.75. So the net amount that we are going to pay is this much. Hence, there is a USD 541 arbitrage gain. This is the arbitrage gain that is there. Okay, students. This is the arbitrage process. I hope this is clear and understood. Now with this, let us break for 10 minutes. We will again reconvene at 8:49. Welcome back, students. So, as we have just seen how to do the arbitrage process, we have studied two cases. One is in if it is case underpriced and overpriced, how to follow the arbitrage process in both the cases. And for case number one, we just now have solved the last question. Okay. Uh, this is question number third. Yeah. Now, Namita, there is a question from Namita. Sir, our risk starts from the beginning 6 months. So why we are taking FRA on zero period? Take it at the start of 6 months. So Namita, if we are going to take the FRA at 6th month, then there is no need of FRA at all. Why? Because you will be doing the transactions on actual basis. Now here the risk does not start from 6 months. The interest starts from 6 months. The risk starts from 0 day itself. Why? Because today you are aware of a fact that you have to borrow or you have to invest certain amount. Correct? That you have to do, and the rate is not known to you. Hence, there is a need for you to do the changes or do the FRA agreement. Correct? Now let us go to the interest rate futures. So with this, our FRA is more or less complete. Now we are going to the third technique under the modern approach, interest rate futures. Okay. Now, first of all, students, interest rate futures, there is nothing called as, let's say, FRA 3/6 that is taking place on stock exchanges. There is nothing like that. Okay. There are no standard contracts of FRA that gets traded. They rather what we do is that there is a bonds market. Correct? Bonds are being traded. Bonds are those type of securities which have a very good relationship with the interest rates, because interest is actually the substantial factor which affects the bonds prices. Correct? So what we do is we take the bonds prices to hedge against the interest rate changes. Now, for example, you have to hedge yourself against the interest rate going up. If the interest rate goes up, the bond prices will go down, correct? So what you are going to do is you are going to short sell the bond futures. That is what you are going to do, correct? If the interest rates are expected to go down, if the interest rate goes down, the bond prices will go up. Why? Because there is an inverse relationship. Correct. So the bond price will go up, and as a result, you will take a long position in bond futures. Correct? Is also understood? So what we are trying to say here is, for interest rate futures, we use bond price movements to hedge against the interest rate changes. And these contracts are standard contracts that are dealt on the stock exchanges. I'm talking about these bonds, okay, not the interest rates themselves. Namita, please clarify the question because I just got this thing mentioned as sir 6.75. Okay. Just clarify the exact question. Now let us go to question number 4. That's all on interest rate futures. In interest rate futures, just keep thing in one mind. We are making use of the future contract, which is a bond contract. Simple. Okay. Now, Electra space. Now understand this question. This question is very, very, very good and very practical question. Okay. Electra space is a consumer electronics wholesaler. So try to understand the business of Electra space. They are into the consumer electronics wholesaler. For example, television, for example, air conditioner, correct? All these things they sell. For example, now they are selling AC or they are selling something. Because of that, the business of the firm is highly seasonal in nature. There is a seasonality attached to it. In 6 months of a year, the firm has a huge cash deposits, and especially near Christmas time, because they are having good sales at that point of time, their cash flow is seamless. They are able to generate good amount of cash flows there during the Christmas time. And other 6 months is a firm is a cash crunch. They are facing cash shortages. They are facing liquidity shortages. Correct? The other 6 months. And in that other 6 months, they have a need to borrow of money to cover up its exposure for running the businesses, because they have to pay salary, they have to pay overheads, they have to pay rents, they have to pay all the amounts. So hence, they have to borrow the money to run their business for the balance 6 months. First 6 months, they are having extra cash which they have to invest, for example. Correct. And the next 6 months, they are short of cash and they have to borrow. Now, it is expected that firm shall borrow a sum of 50 million euros for the entire period of slack season. Slack season is the 6 months where there is a low sales, low cash, low profitability, everything. Correct. Where there is less sales. And that slack season is about to come in 3 months. Okay. Now, this is actually a issue of FRA 3 by 9. Correct? Because from the third month from now, it is going to start and it will be there for 6 months. Correct? With this, can we frame some FRA in our mind as FRA 3 by 9? 0 to 6 months, 6 to 12 months. Here they are having surplus cash. Here they are having deficit on cash. Correct? We are here on 3 months. So 3 months from now, the slack season will start for 6 months. So we are talking about FRA of 3 by 9. Okay. Now, for borrowing the sum of euro 50 million, so first of all, the question has directed us to the 6 months, the deficit period of 6 months. It has asked us to ignore the cash surplus that is available with them for the first 6 months. Correct? Because the question through this line has directed all of us to think only on the borrowings through FRA. Correct? Now, the bank has given the following quotations. Spot price, this is the quotation, 3 by 6 FRA, 3 by 9 FRA. And again, the spread, correct? The bid ask spread is given. Sorry, the bid ask rate is given, not the spread. So 5.94 is the rate that will apply to us if we are going to purchase a 3 by 9 FRA. What is our requirement? 3 by 9 FRA. So spot and 3 by 6, no use. Only 3 by 9 FRA is of use. And within this also 5.94 is the right rate. Correct? Because if you are going to sell the FRA or invest through FRA, then 5.64 would have been the right rate. But here we have to borrow. Correct? Now the next part says 3 months euro 50,000 future contract. Maturity in a period of 3 months is quoted at 94.14. And the question has also said that it means that interest rate is 5.85. Correct? Okay, so 100 minus 94.15 is actually 5.85%, which is the other way to see this. Okay. Now, this is something that is given on the futures. This is something that is given in the forwards. This is futures. Now, see what the question is asking us to do. You are required to determine how a FRA shall be useful if the actual interest rate after 3 months turns out to be 4.5 or 6.5. First of all, this is very easy for us. We will enter into an FRA of 5.94. Correct? So let us solve the first part. 3 by 9 FRA purchase at the rate of 5.94%. Simple. So there are two possibilities that are given, 4.5% and 6.5%. There are two possibilities. What if there are these two situations? So first of all, we are going to purchase FRA. In both the situations, it will be 5.94 percentage, 5.94 percentage. So here, what do you think? There is a loss or there is a gain? There is a loss here and there is a gain here, because in the open market you are able to get the loan at 4.5 percentage, but you have already entered into an FRA which says that the borrowing percentage will be 5.94. That means you are at a loss, correct? You are at a disadvantageous situation, and that loss is how much? 5.94 minus 4.5, which is 1.44 percentage. In this case, the outside rate is 6.5 percentage, but you are eligible for purchasing the FRA at 5.94. That means you are able to gain 0.56 percentage here. Okay, there is a gain. Sorry, in this part only, now we will calculate the amount. Now, students, if you see FRA payments will be on differential basis. Okay, Namita, I missed your one of the question. Sir, in study material, it is written that principal amount is never exchanged in actual, it is notional. Yes, Namita. That's why we say that as a notional amount also. In all our examples, we have only settled through net basis. We have not settled through gross basis. Okay. So FRA payments is going to be how much? Here it is a loss, hence it is going to be a payment. What is the payment amount? So 1.44 percentage. What is the notional amount? 50 euros for 6 months. Correct? That becomes 3,60,000 as the payment. Here we are going to receive 0.56 percentage on 50 million euros for 6 months. So 1,40,000 is what we are going to receive. Okay, students? And what is the interest for 6 months? Actually, we are going to pay. Here we are going to pay as 4.5 percentage on 50 million euros for 1/2. 112. This is the interest payment that we're going to do. And here, sorry, the interest payment will happen at 6.5 percentage for 50 million for 6/12. So 16,25,000 is the amount that we are going to pay interest here and this one here. So this is also a payment, but now here in this case, we will add up 360 plus 11,25,000. So which will be 14,85,000. We are going to pay this much. We are going to receive this much. That means net. We are going to have a cash outflow of 1485. Now, students, if you see in both the cases, while entering into the FRA, the net amount to be paid is same. Correct? The rate of 5.94 percentage is committed. See how we have come to this 5.94 also is this 5.94. Correct? We can prove this also. How? 1485 divided by principal amount is how much? 50 million multiplied by 100, correct, for the percentage, and this is actually for the 6 months, so into 12/6 to arrive at a per annum rate. So 5.9 percentage per annum. So hence this is the same rate, correct, at which we have contracted for entering into the FRA. Now comes the next part. So this is all what we have studied earlier. Now comes the interest rate futures. Now, using futures, let me put here. Second part. Now, just see what the second part is asking us. How 3 months futures contract should be useful for a company if the interest rate turns out as mentioned in part A above. Now they are saying instead of FRA, you use 3 months future to and calculate the impact of 4.5 and 6.5%. Now, first of all, we need the borrowing, correct? We need the money. That means we need to have a long position. If we need to have a long position in borrowing, we need to have a short position in the futures market because we are going to use the bond prices. Bond prices, how much? 94.15. Correct, because there is an inverse relationship that we have already studied. So interest rate, if it is going to go up, the price of future is going to go down. This is first of all, we know, correct? So from 94.15, it will go down, correct? Okay. Okay, so now Namita is asking a good question in this. Why we are not calculating FRA payment by using formula. So Namita, actually, if you see, this is just a numerator of that formula. Denominator we have not taken here. Why? Because we have done the calculations at the end of the period in this case. Okay. We have done the calculations at the end of the period. You can also do the calculations at the beginning of the period also. We are okay with that. So, but I have taken at the end, so we can do that also, Namita. Okay. Harshad is asking, sir, in question 3, we are first taking loan at 5% for 6 months and investing the same in same market for 6.5 for 12 months. And today we are also taking a FRA at this for 6 months. And as a result, we are earning, yes, Harshad, that's right. As a result, we are earning 541 USD from the entire situation. Correct? That is what the arbitrage is helping us out with. Okay. So this is okay. Now coming to the futures one. Okay. Now, first of all, students, in this case, what I also want to highlight is borrowing exposure is for how many months? It is for 6 months. Correct? But the available tool with us, available futures with us are at 3 months of maturity. Correct? So how can we use 3 months to hedge against the borrowing exposure of 6 months? That means we have to enter twice of what we are going to enter for futures so that it becomes 6 months coverage for us. Correct? So hence we will have to multiply it by 2 so as to arrive at for the 6 months exposure, because the tool gives us only 3 months exposure. So 3 into 2, if we do, we will arrive at the 6 months. Correct? Or I will tell you again in the same or similar case how to understand it differently. Now we have two cases, 6.5, 6.5 and 4.5%. So first point, we are going to sell futures. Selling future will happen at what rate? 94.15, 94.15. Correct? But how many future contracts we have to sell? Number of future contracts. See, 50 million is the total amount. Sorry. And one contract is available at 50,000. futures contract, the lot size is 50,000. But as we said that we have to multiply it with 2. We can't say that one future will one future will do the hedging for exactly 1 rupee, or let's say 150,000 euros. It won't do that. Hence, we can also understand this is in such a manner that we need to hedge against the 6 months of exposure, and the available amount or the available time period is only 3 months. Hence, 6 divided by 3 also we are going to multiply. So that means if we are going to enter into 2000 contracts and we are going to sell them at 94.15, according to us, the hedging is done. Now we have to prove how, correct? Now, in this case, price of futures, correct? In a future date, I'm saying once the settlement comes, what is the price of future here? So if you see, it will be how much now? 4.5 is the rate, correct? At the settlement date. So it will be 100 minus 4.5, which is 95.50. Similarly, here it will be how much? 100 minus 6.5, which is 93.50. Correct. And if I want to say that what is the gain slash loss, so there is a other way to calculate this. What it is, this is because in this case we have seen the prices of the futures, not the interest rates, correct? So if we see the interest rates also, the contracted rate is how much? 4.85. Sorry, 5.85. Is how much? 5.85. Correct. That is the contracted rate. Yeah. So 5.85 minus 4.5. This is a loss. Correct. We can say 1.35 percentage is a loss. Similarly, here there is a gain. 6.5 minus 5.85. Correct. So there is a 0.65 percentage gain. Okay. So this is giving us a 6.5 percentage of, sorry, 0.65 percentage of gain and 1.35 percentage of a loss. Okay. Now, this is just a percentage that I am trying to put here. Now, what will happen for the cash settlement? The cash settlement will be how much? This 1.35 percentage on 2000 contracts, 50,000 each, correct? For 3 by 12 months. This for 3 months only. Because the time period for borrowing is only 3 months. Similarly, here also 0.65 percentage for 2000 contracts for 50,000 lot size in one contract for 3 months will be the gain. This is the gain and this is the loss. Okay. This is the loss because of selling the futures. This is the gain because of purchasing the, sorry, this is the gain because of selling the futures. Because the price has gone down, correct? And so if we calculate this, this comes as 337, 500, 162, 500, correct? Hence, interest on regular borrowing also we have to pay, correct? So on 50 million, we will pay an interest of how much? 4.5 percentage for 1 by 2. See students, again, please note why we have done 3 by 12 here, not 6 by 12. Some of you might be wondering. The reason is the time period for the future contract is 3 months, correct? And If you have to do 6 months here, then you could have taken 1,000 contracts only. You're getting my point. But since already that 2 is multiplied in the number of contracts, we have taken the exact duration of the future, which is 3 months. Correct? And this interest on borrowing will be paid on 50 million at the rate of 4.5% for 6 months. Correct? And here it will be paid as 50 million multiplied by 6.5% for 6 months. Correct? So this will be 11,25,000. This will be 16,25,000. So this is the interest paid on borrowing. This is the gain here and this is the loss here. So loss will be added to the payment and gain will be reduced from the payment. We will end up at 1462,500. 1462,500. In both the cases, our net cash outflow is same. The interest cost is same. And we can also calculate the effective percentage like we did in the forwards also. 1462,500 divided by 50 million multiplied by 100 multiplied by 12 by 6. So this gives us a rate of 5.85%, which is the original contracted rate under futures. This is the rate at which we have entered into the interest rate futures. The same rate is applicable as per the calculation that what we did. This is all about the interest rate futures. So in interest rate futures, we have to just keep one thing in mind is we are going to do the hedging part. We are going to do the hedging part, protection part using the interest rate futures, that is bonds futures, which have a totally inverse relationship with the bond prices. Correct? So those bond prices have an inverse relationship with the interest rates, is what I'm trying to say. Okay. And using that, we will do the opposite movements in the interest rate markets. And using that, whatever is the exchange, so whatever is the deal rate of 94.15, essentially we are blocking the entire interest outflow as 5.85% only. Okay, students, this is what the solution is. Now let us go to the fourth technique. Okay, students. So now let's come to the next part, which is called as interest rate option / guarantee. Now, till now, we have studied FRA, okay, then interest rate futures, and now we are going to study options. This is very much similar to what we studied in derivatives. Derivatives, we first of all studied forwards, then futures, and then options, correct? And the same logic applies to these interest rates as well. Now, what are these interest rate options / guarantee? Here we also call as guarantee. Okay, I'll tell you why. So the first and foremost thing, these are the rights, but not obligations. Okay. See, in FRA and futures, if the situation becomes disadvantageous to us, we still have to go and honor the contract. We don't have any right to go out of the contract. But in case of options, we have an option to go out and not to execute the transaction if there is a disadvantageous situation to us. Okay. But in the interest rate options, as we say that it is a right in which we can exercise the option and we cannot exercise the option depending on what the situation is. Okay, then it can be exercised in case of favorable situation, cannot be exercised in case of unfavorable situation. So there is a right of not, so the right of not exercising it is also there in case of as an unfavorable situation. Okay. Harshad, you can ignore that spelling mistake in information of lecture. Okay. Understand the essence behind it. It is strategic only. Okay. It's not strategic. Okay. So pay attention here. We say that interest rate options or guarantees are rights, but not the obligations. Correct? That gives the right to exercise in case of a favorable situation, and also we have an option of not exercising it in case of an unfavorable situation. Very similar to what we studied in the future then or in the derivative segment. Now, I'm just depicting it here. So what we studied there, I'm just using the same flow chart that I prepared there. For example, A is a contract. Okay. This gives the right. This gives the privilege, but not an obligation. Not obligation. It's not an obligation. It's a contract. It's a right. It's a privilege. For what? To borrow. In derivatives, it was to purchase, correct? If we talk about call option there, it was to purchase. Here, the contract right option is to borrow a specified amount. Already the amount is specified, the notional amount, correct? This is the notional amount at specified interest rate. The interest rate is also specified. Okay. On specified date. Simple. So interest rate guarantee or interest rate option is an option to borrow a specified amount, which is called as a notional amount at specified interest rate on a specified date. Okay. Now, in this, we call this type of arrangement as a cap option. Cap. Because this is putting a cap to your borrowing rate. This rate is called as cap rate because if it is going above the cap rate, you can easily exercise the option and bring down the cost of borrowing equivalent to the cap rate. We will understand how. Correct. Specified date means these are the reset dates, the dates on which the comparison between the actual rate and the cap rate will happen. These are called as reset dates. We will study those. Correct. And similarly, there is a buyer of cap option who will have the right to borrow, and there is a seller of cap option. Please mind my words. This seller of the cap option is selling the rights to borrow. Correct. He's buying the rights to borrow. He's selling the rights to borrow, not the actual borrowing or lending is happening. They are just selling and buying the rights to borrow. That's all. And this type of an arrangement is called as a cap option because in this the rate is capped at a certain amount. Now comes the second part. So now A is again a right, privilege, option, all those things. But here instead of to borrow, Here it is to lend or to invest. Correct? Instead of borrowing, now it gives us the right to invest. Specified amount, specified rate of interest. A specified amount at a specified rate of interest on specified date, which is the reset date. This will be the reset date on which the comparison between the actual rate and the specified rate will happen. Now, in this case, the minimum rate is guaranteed on the investment is this. So hence we call this as floor rate. Because if the rate goes down below this rate, the holder of this option will exercise this option and make good the loss if there is any. Similarly, this is called as cap rate. This is called as floor rate. And this entire arrangement is called as floor option, because it is creating the minimum rate at which the return will be given. And in case of a cap option, it is capping the maximum rate at which the interest can be paid on borrowing. This is for borrowers and this is for lenders or investors. Similarly, here there is a buyer, there is a seller, buyer of floor option, okay, and seller of floor option. What is the buyer of floor option is doing? Buyer of floor option is buying the right to invest. Seller of the floor option is selling the right to invest. And since these are options or guarantees, whether it is a cap option or there is a floor option, we have studied very well in our derivative segment that there is a premium involved. Premium will be paid by buyer, received by seller. Okay, students. These are called as interest rate options. Why do we call them guarantee? Because these options will guarantee you a rate of cap rate in case of a cap option, correct? And it will guarantee you a floor rate in case of a floor option. That's why these are called as interest rate guarantees. And as I told that reset dates for the purpose of questions are those dates at which we compare the actual rate with the options, cap rate or floor rate, whatever it is. Now, Namita is asking, sir, in FRA, interest rate mentioned in the agreement, why we call it as a price? Because FRA, see, the price of that FRA is always the interest percentage only, correct? Basis that only we are able to understand whether it is overpriced, it is underpriced, correct? Hence, that term is used interchangeably. The price of a FRA is the percentage at which it is quoted, the rate of interest, basically. Okay. Namita is asking, sir, in interest rate futures are traded? Yes, those are traded in stock market because those are actually the bonds futures themselves. Okay. And those are traded on the stock market. Coming to question number 5. Now, question number 5 says that XYZ Limited borrows bond 15 million of 6 months LIBOR plus 10% for a period of 24 months. See, the first line itself told you a lot of things. The notional amount is 15 million. 6 months LIBOR is the rate, is the base rate. 10% is the spread. 24 months is the time period. The company anticipates a rise in LIBOR. Now, the company. Okay, wait. Before reading this question, let me take 2 more queries. Harshad is saying, why invest in return should say lend? Which can be anything. Okay. So, Harshad, if you're asking me here, to lend or to invest, anything. we are giving the right to lend or to invest, because lending is equal to investment only, right? Because lending is also done for the point of view of investment. That's why, Harshad, I have used both the terms interchangeably. Now, Namita is asking, sir, holder of floor option will exercise when interest rates are lower than the agreed rate. So why it is minimum rate? No, it is maximum. No, Namita, see, why it is minimum rate? Okay, I'll tell you. So let me add one more sheet before this question. I am talking about both cap option and floor option. I'm talking from the point of view of holder. Correct? Holder means the person who has purchased. This is the holder. Now, cap option, the interest rate, the cap rate is at, let's say, 10%. And here also the floor rate is, for example, at 10%. Correct? These are two different scenarios I am discussing. Now, the actual interest rate goes up to 12% in both the cases. Now, what will happen? The person who is holding the cap option will have an option to borrow at 10%, and in the open market he can borrow at 12%. Don't you think this option is a privilege for him? Yes. So he will receive 2%. Correct? Cap option holder, I'm saying. For a floor option holder, he will say that I have an option to invest at 10%, but in the open market I can easily invest at 12%. So it is not a right anymore for me. Hence, no gain, no loss under the option, but I can easily go and invest in the open market at 12%. Simple. Now, what if the actual rate is at 8%? What if the actual rate is at 8%? Okay, before that, if the actual rate is 12%, what I'm going to do is I'm going to pay 12% on the borrowing. I'm going to receive 2% here. My rate is capped at 10%. You're getting my point. This is called as cap option. I'm not discussing maybe 8%. And in this case, floor option, I'm going to invest at 12% directly. Simple. Now coming to the other case, if there is an actual percentage of 8, if there is an actual 8% borrowing percentage available in the market, why will I exercise the option? Because option can be exercised at 10%. I will go in the open market and take at 8%. Correct? Interest payment will be at 8%. This will be minus. But in this case, I have a right to invest at 10%, even if the open market is offering only 8% to me. So hence, I will receive 2% under the option, and I will receive 8% from the open market. Hence, I am getting a minimum of 10%. Hence, this is called as floor option. This is called as floor rate, because in case the rate goes down to 8, still you are able to make 10%. This is the floor rate. In case the rate goes down to 12, still you are able to pay only 10% in case of a cap option. Hence, it is the capped rate. Okay, Namita, I hope I answered the doubt that you had. Okay. So, Namita, your question was, I'm repeating again, sir, holder of floor option will exercise when interest rates are lower than agreed rate. That is very much possible. That is very much true. Hence, it is called as a minimum rate. Correct? We can't call it as a maximum rate. This is a minimum rate, because tomorrow, if the rate is 12, he will get 12 from the open market. Correct? And similarly, here, the maximum rate is 10 and the minimum rate can be anything for the cap option, I'm saying. Harshad is asking, sorry, I saw half and other thing is where you simple interest only today. Bank also charge compound interest. Okay. Okay. Got it. We use simple interest only today. Bank. Right. Harshad, that's right. The same. See, the only difference between the simple and compounding is the use of exponential function. Correct. We can very well eliminate all the simple interest with the compounded interest as well. with a daily compounding. Okay, so that is okay from the practical standpoint, Arshad. Namita sir, so we can say that floor option concept is similar to put option. Yes, Namita, that's right. Okay, cap option is call option, floor option is put option. Just for the saying, correct? But we have separate terminologies for both of them. Okay, students. So now coming to question number 5. XYZ Limited borrows 0.15 million for 6 months LIBOR plus 10% for a period of 24 months. The company anticipates a rise in LIBOR, hence it proposes to buy a cap option. Very easy, very simple. They are proposing to buy a cap option from its bankers at the strike rate of 8%. Now, students, please note, this strike rate of 8% is not applicable for LIBOR plus 10%. It is only applicable for LIBOR. So LIBOR will be compared with the 8%, not LIBOR plus 10% will be compared with the 8%. I hope you're getting my point. We will go to the solution. The lump sum premium is 1% for the entire reset periods. They are saying that the lump sum premium is 1% for the entire reset periods, and the fixed rate of interest is 7% per annum. This is the rate we will use for discounting. This is why it is given as 7%. The actual position of LIBOR during the forthcoming reset period is as under 1, 2, 3. These are the different LIBORs that are available. Yes, Arshad, answer will be right only. So never you will be questioned on using the compounding or simple interest, but better to use simple interest because the testing here is happening on the concepts, right? Not on the compounding or simple interest. But if the question gives you the indication that you have to calculate using the compounding interest, you will have to use the compounding interest. Okay, Arshad? Now there are, for these three different reset periods, you are given the three different LIBORs. You are required to show how far interest rate risk is hedged through the cap option. For calculation, work out figures at each stage up to the 4 decimal points and nearest to each. It should be part of the working notes. Okay. Now, first of all, amount required. Now, what is the amount required? It is 15 million pounds. Correct. Now, cap option is 8% against, we have to compare against LIBOR, correct? Which is the strike rate or cap rate. In this question, students, please note, I am assuming there are 4 reset periods. See, there is a total duration of 24 months. I am assuming 4 reset periods for 6 months. Okay. We're assuming 4 reset periods for 6 months. Now, what will happen, students? See, first of all, we have to calculate the gain or loss at the each reset period. That we can calculate very easily because we have the LIBORs also and we have the cap rates also. That we can calculate. But if you see 0, 1, 2, 3, and 4. Now, if you see, students, we are standing here. We have 4 reset periods. Today only we are paying the premium, correct? So I want to calculate a equal installment of the premium on each of these 4 periods using the 7% per annum, which I will compare against the payoffs happening on these reset periods. Okay. So first of all, the total premium will be 15 million multiplied by 1%, which is equal to bonds 15,000. Correct? Now, this 15,000 is actually 0-day value. I want to split it into the 4. I split it into the 4 exact amounts. Okay. So I'm assuming those exact amounts as this: 1 plus 7%, 1 by 2 plus x divided by 1 plus 7 percentage into 1 by 2 square, correct? Because this is the compounding happening for 2 months. Sorry, 2 reset periods. This is the compounding happening for 1 reset period plus x divided by 1 plus 7 percentage into 1 by 2 raised to the power 3. This is the compounding happening for 3 reset periods. Similarly, the last part will be x divided by 1 plus 7 percentage 1 by 2 raised to the power 4. This is the compounding happening for 4 reset periods. Okay. So using calculating this, I'm not again going into the step-by-step calculation because of the time constraint. So this is 40,861. This is actually 1,50,000. 1,50,000. So for 4 reset periods, equally the amount comes as 40,861. Now I can compare this with the actual cash outflow and inflow that is happening on each and of these reset periods. Now, calculation of net payoffs. See, students, in the question, we are only given for the 3 reset periods. We are not given any data for the 4th reset period. Hence, we can ignore the 4th reset period as of now. We will only calculate the gain or loss on the each reset period that is given. So reset period 1, 2, and 3. What is the LIBOR? LIBOR is 9%, 9.5%, and 10%. The cap rate under the interest rate of guarantee is how much? 8%, 8%, and 8%. So we will get differential from bank. Now see, students, the open market is at 9%. We have a cap option at 8%. There is a gain to us because of this around 1% of 15 million for 6 months, correct? Which is equal to 75,000. Here also 9.5 is the open market rate. We have an option to take the loan at 8%. There is a 1.5% benefit coming from here. Again for 6 months. So Sairam, we have taken 1 by 2 because it is for 6 months. You can take this as 6 by 12 also. Because we have assumed the reset period to be 6 months. See, that is what I assumed here. Correct? 6 months is the reset period. Yes, Harshad, I have corrected that. 15 million into 1% is 1,50,000. So I've corrected this. Students, please also note this correction. 1,50,000 is the amount. Okay, thank you, Harshad. Namita, okay, we'll try to see if there is any question that comes under the compound interest, then we'll solve it. Otherwise, it's the same concepts has to be applied on the compounding interest as well. Okay. Now, here, what is the amount of payoff? It will be 1,12,500. Now, in this case, 10% is the open market interest that needs to be paid. The interest rate guarantee is operating at 8%, which is the strike percentage. So 2% will be the gain. Okay, students. This will give us 1,50,000. So these are the differentials from the bank that we will receive. And there is a premium cost on each reset period, which we have already calculated in the form of a amount, which is 40,861. Because we have calculated this as a equal amounts. So 4861. So this is the exact equal amount. If all of them we will take a present value of, we will get 1,50,000. This is what we did using this formula, correct? Using this equation, right? So the net inflow will be 75,000 minus 40,861, which comes as 34,139. Then comes 71,639. Then comes as 109,139. Okay, I will explain that, Harshad. Just give me a second. Let us just total this. 2,14,917. And this was how much? 3,37,500. Now, students, please note, if we have not entered into the cap option, then we would have not got a benefit of this 214,917. This is the net inflow, right? Correct. So because of the interest rate option, we are able to get a benefit of 214,917. So we can say that the extent, because in the question it is asked specifically, you're required to show how far the interest rate risk is hedged through cap option. Correct. The extent by which interest cap option have hedged the risk is 214,917. Correct, because if we have not entered, then we would have been paying the interest at 9%, 9.5%, and 10%, which is definitely the higher interest. But since our interest is capped at 8% using the cap option, we are very well able to manage the 214,917 amount through the entire arrangement because we are paying the premium also. Okay. Now Harshad is saying premium calculation. Okay, Harshad, let me explain the premium calculation. See, Harshad, as of now, the question very clearly says that 1% premium is paid for the entire reset periods. That is, first of all, established. So for 15 million, 1% comes as 1,50,000. Now, since we have to calculate at each of these three reset periods, what is the net payoff that has happened? Hence, what we have done is we can't compare any cash flow here with the zero cash flow, correct? As of now, 1,50,000 is the 0-day cash flow. So to arrive at the equated cash flows at first, second, third, and fourth reset period, we have calculated a equal amount. This is kind of a EMI only, equated installment, correct? And using that EMI, we have seen that what is the net amount that is payable and calculated the net cash inflow. So Namita, yes. Now that was my last part of the discussion, which Namita has very well mentioned. She's saying, sir, if we assume three reset periods, then what is the change in solution? So Namita, you in that case, because I was also going to explain that only, if we assume that there are three reset periods, first of all, the reset period will be for 8 months instead of 6 months, correct? Because 8 months multiplied by 3 will be 24 months. This is what the time period is. So that is one change. Second change is your EMI, this formula, this compounding formula, the last, this number will not be there. Correct? This number will not be there. And instead of doing 6 by 12 here or 1 by 2 here, whichever it is, we will do 8 by 12 now in the formula. Okay, that's the only change. Apart from that, there is no other change. Okay. I hope the queries are clear. Okay, now let us move to the last discussion of the today's session, which is interest rate collars. The students, till now we have studied the interest rate caps, and floors. Correct? So there is a strategy using which we can build interest rate collars. Okay, what is that strategy? Strategy is that to purchase a cap and to sell a floor. There is a very good question on this. We will understand this question. Okay. Just a second. Harshad is asking why we are not writing last minimum. That's what Harshad that's what if we assume 3 periods, 3 reset periods, then for the 3 reset periods, we have done the calculation. And for the 3 of them, whatever is the installment is doing, we are coming and reducing that. Correct? Okay. Now, why we are doing this purchasing a cap and selling a floor? Why? Because while we purchase a cap option, we have to pay premium. That additional premium of this 1,50,000, for example, this 1,50,000 in the previous question itself is what we are going to pay as an additional cost. Now, what if we have to avoid that cost is to sell a floor and receive the premium? That is the first advantage. Correct? And if there is a differential in the interest rates, that will make sure that, so for example, cap you are entering at, let's say 10%, and floor you are entering at 4%. So that will make sure that you are always operating between 10 to 4%. We will prove how with the next question. We will prove how. Okay. You will make a boundary. Your borrowing will not go more than 10%, and your borrowing will not come less than 4% in any of the case, keeping your entire cost constant because the premium is set it off here. Correct? Okay. Now let us go to the question number 6. Okay.
Divas?
Yes, sir.
I think this question will take some more time.
Okay, sir.
So I think, can you take that in the next class if you are comfortable? Otherwise,
yes, sir. Yes, sir. We can cover this in the next class.
Because I think it will take some more time.
Yes, sir. Yes.
Okay, and there's only 5 to 10 minutes have been left.
Sure, sir. Sure, sir.
Can I conclude the session?
Yes, sir. Yes, sir. Please, sir. Yeah.
Okay. Okay.
Over to you, sir.
Can you stop sharing the iPad?
Yes, sir. Yes, sir.
Welcome, students. First of all, Happy New Year to you. Because we have entered into a new era of 2022, and I wish you all the students to bring that this year brings flying colors for you, and you become the chartered accountant this year. I pray to the God. But with this new era, there is one thing I would like to discuss: a contemporary development. In the class, Divas was discussing regarding that point base rate. Okay, it is also called benchmark rate because it is considered as a basis. Okay, student. So what happens? Normally, we like if you recall that in your forex, when we were used to do the forex question, there was used to be interbank market rate. Okay, so in the interbanking market rate, we used to add some basis point for calculating the, or we used to add some margin. Okay, that to calculate the merchant rate or the retail rates. Here, same way when we deal with the interest rate banks, so normally they use some benchmark rate. It can be as Devasa use the MIBOR, etc. Now, one term he has used very frequently, and that is LIBOR, or we can say that. But I would like to make you inform that students, with this 1 January 2022, this LIBOR has come to an end. Okay, this is and because it was around in 2012, some scam was come out with the Barclays Bank and other banks were involved, but Barclays was the main bank. And as per their decision, it will not be no more, because normally what happens, there are many rates like LIBOR, dollar rate, LIBOR, euro rate. So accordingly, this is going to an end. Of course, for the ongoing contract, it is, I think, up to 30th June 2023. It will continue for existing contract only. But after 1 January 2022, no financial instrument based on the LIBOR will be issued. It is very important because it is also very important for your interview also. Even Recently, the India's largest lender, that is SBI, State Bank of India, has announced that they are coming out. They are making them conversant, or they are making them based according to the new rate. It is also called alternative reference rate. There, it is called ARR, and even it is where ICA has come out with some guys say guidance notes for switching over this to the new rate. From accounting point of view, it is not from the financial management. Now, student, I was just like to share with you what are the alternative reference rates. Just I am just the screen 1 minute. Now, these alternative rates are accordingly they are currency based. Okay, earlier they used to be Libor USD, Libor Great Britain Pound, Libor Euro, but now it has been changed. Now, for USD rates, it is called SOFR. The full form is Secured Overnight Index Average. Sorry, and over my mistake. It is Secured Overnight Financing Rate. Okay. Then for Great Britain Pound, GBP, it is Sonium. That is Sterling Overnight Index Average. Yeah. And for Japanese yen, it is Tokyo Overnight Average Rate. That is called honor. And for euro, it is ESTA. And full form is Euro Short Term Rate. Okay, and for Swiss franc, is average rate overnight rate. It is called SARAN. So, student, I was thinking to share this information with you, and more importantly, this is because since it is a contemporary type of a topic, and I think you should understand the same. Because even a question can be asked, we cannot deny the same. Of course, we shall continue to use LIBOR in the book, and it will not be wrong. Now, one or two query I was want to discuss with you. One student was asking something regarding notional principal in FRA. Of course, Divas sir has discussed with you, but I am just saying my one example. If Divas permits me, Divas, can I?
Yes, sir. Yes, sir. Please, sir. Please, sir.
Suppose if you approach to HDFC for a loan of say 5 crore, okay, the rate maybe it can be prime lending rate, PLR, MCLR, because it can be anything. Marginal cost of lending rate, it can be anything. So it can be anyone. Okay, just we say okay, benchmark rate say MIBOR or whatever we take MIBOR plus 50 basis point. Okay, now not really 50, so 150. Very now, since you have application that MIBOR may be on a rise in a coming future, the period may be for 6 months and 6 months loan you want to take after 3 months. So you are at you will have to take the forward rate agreement for the 3 into 9. Okay, but this agreement you will not take with the HDFC. You may approach to some other bank, say to approach to ICAI. Okay, friend. Now, in this case, what happens? Your principal settlement will be with the HDFC because you are taking the loan from HDFC, but your taking the agreement with the ICAI. So here you will not exchange the principal with the ICAI bank, but only you will make the some settlement. Okay, and that settlement will be your benefit. The settlement will be your benefit. That is the most important point. Okay, so I hope now it must be clear to you what is the purpose of the notional reserve. Now, one student was asking about the compounding. I think in the end he was asking some compounding. What is what? Student, please note in this question, the premium is considering the concept of compounding itself because the formula is like that. It is considering the present value factor. Second thing, one now unless and until in the given in the question, because here what happens, the reset period are 1, 2, 3. And remember one thing, if we are entering into a 2 years agreement, the period is 2 years and reset period is every 6 months. So you will say that there are 4 reset periods. But please note, today we know the what is the rate existing in the market. So today's date is zeroed out. Okay, the days left are 1, 2, and 3 only. Okay, so accordingly only 3 periods. So today's rate is known to you, known to me also. We are betting or we are hedging only on the future rate. So future rate will be only for the 3 reset period only. You got it? So that's why you have to consider only 1, 2, and 3. And more important, regarding the compounding, see student, here the 6-month period is there. The compounding concept normally comes when the duration is more than say 1 year. There it plays a role. Of course, in derivative instrument, we normally use the 1 month compounding and even we use the daily compounding. But here normally it is less used because in derivative, we used to compute the valuation of the instrument. Here we are not using any valuation. Of course, we are making some settlement. So, but of course, as student is saying, sir, if we do the with the compounding, the answer will be wrong, sir. Student, I cannot guarantee in this matter because now when questions are very straightforward and they are from the, we are following that because I don't think in an interest rate swap it is interest rate instrument where we are except 1 or 2 questions. We are normally using the simple interest or simple compound because ultimately 6 months there is not much that much compound will not make that much of effect. So accordingly, you go by the same what has been covered in the study material. Of course, if there is any confusion is there, then of course we shall consider both solutions. If there any line is there, then you have to worry, we can consider both. So with this, we enter this session, and I am very happy the way the queries are coming and the students were engaged with the Divas. I was very happy. Students because they are asking each moment. I was seeing them; they are asking queries. Thanks a lot, Divas, for making your instructions. Your session is such interactive. And student, now our class will be on. I think first our class will be on. I think it will be day after tomorrow. Yes, and I will cover the this topic. You will cover this topic. Internet man will be obviously.
Yes, sir.
Okay. Okay, students. Whatever your queries, I forgot to share my email ID. I am just sharing 1 minute. Just a second, sir. As usual, you can send your email at sfm-final at ICAI.in, or you can contact me. Okay, student, this is the STD code and this is my number. So you can contact me over the telephone also, no problem. So see you day after tomorrow. Thanks a lot, Divas, and thanks for your patience. Have a nice day.
Thank you, sir, for sharing your expert thoughts. Thank you, sir, for sharing your expert thought because the LIBOR update was very new to me also. Thank you, sir.
Yeah.
Thank you,
okay,
sir.
okay, but we shall discuss and Divas, just give me a call after I think around 11 o'clock.
Sure, sir.
Okay, I have to discuss something with you. Okay.
Sure, sir. Sure, sir. Okay, sir.
Okay.
Thank you, sir.
Thank you.
Okay. Thank you.
Okay.
Bye.